Well, look, hey, let's get started. Happy Tuesday, everybody, and thanks for coming in from all over the country and putting where you're coming in from. So today. I'm just very excited about today. I've been thinking about it actually for a couple of weeks now, knowing that I was going to have really for the first time Carson today as my guest, and we're going to talk about. I'm going to give Carson the intro here, but before we get going, I want to first and foremost just remind everyone here that's listening. Our goal and why we started these Zooms. I don't know how long ago. I feel like 6 months ago is to provide and create education and content for you. Talk about money, to talk about how to unlock your retirement funds, how to use them, what your options are. Tell you the things that maybe your financial advisor won't tell you or doesn't tell you. Tell you the things that maybe you're that break all the rules that maybe your parents or great parents, great grandparents have talked about for so many years or decades, and share success stories. And so today we're going to talk about success stories. We're going to talk about what people are doing with their money. We're going to talk about how to unlock your money. And in doing so, before we get started, as always, my disclaimer. Excuse me. We're not attorneys. We're not financial advisors and or accountants. I will say what we are is very informed people in our spaces. I am an expert in the self-directed space. Carson is an expert in his space, in the banking space we're going to talk about here shortly. So that being said, we're going to share with you real examples of what people are doing. We're going to leave plenty of time here at the end as well to answer lots of questions. That's my favorite part, frankly, is I want to leave lots of time to answer questions. So throughout, as always, my team is listening. They're going to see your questions. Feel free to chime in and put in the chat any questions you have, and we're going to get hopefully to every question you might have. And as always, you're going to get our information as well as far as setting an appointment. And if we don't answer and get to all the questions, we will, maybe not in today's session if there's a lot of questions, but I think there will be a lot today. And so we'll do the best that we can and leave plenty of time for that. So with that disclosure, it's up to you to make your decisions on what's the right fit for you. And I think one of the best things about what I love about this Zoom and having a lot of clients, I'd say half of you that are listening, I recognize your names. You've listened to us a lot. Half of you are brand new to us and you're not sure what self-directed is. So we will talk about some of the basics. But we're going to dive into some deeper conversation today about unlocking your money and banking and how it works. I will say in the last 6 months, we've had guests talking about oil and gas, about Bitcoin, about precious metals, about all kinds of real estate syndications and transactions. I'm trying to think of other asset classes that we've had on here as well. We've talked about something that Carson's invested in, but Carson hasn't spoken about it here. Forklifts. There's all kinds of different asset classes that we try to bring on different individuals that have had success and that people have asked to come on. So we've had Devin Burr on here. We've had Chris Noggle on here, Jay Scram, Kent Clothier, just so many really good just people that know their space. And I'm only good so much in a certain area. And then from there, it's just fun to share and teach. And so that being said, without further ado, I want to introduce my son. Didn't ever plan, by the way. I think a lot of parents think, oh, someday it would be cool if my kid works for me or, he partners with my kid. Just for the record, I never thought it would be cool that he partnered with me or work for me. And for the record, he is not my partner and he does not work for me. He is doing his own thing. And so I think that's what makes it even more exciting is I know that he's learned a lot by default. I mean, I don't know how many phone calls he's had to listen to in the phone, in a car, on a vacation or at home, where I'm talking about money and unlocking, retirement funds, where he was just kind of around it all the time. And I just didn't know what he was going to actually end up doing. And so today, I didn't have just because I wanted, take care of our audience. I didn't want to have Carson come on, a year or two ago when we first started doing Zooms a little bit, because he was still, I wouldn't even say an expert then. I would definitely say that you are an expert in your space now, because I hear you talk about it. The amount of people that you've helped and changed lives in this process has been badass. It's been nothing but short of just incredible to see you do it. And it's fun to see his younger siblings now talk about it because they think that it's Carson's made it look easy. I want to do what Carson's doing. And I'm like, you guys, Carson works really hard and he takes calls all day long, does lots of education for people and finds the right kind of type of clients to talk about unlocking banking. And so but I'm going to let Carson kind of give just a couple minute intro, if you don't mind, kind of to our audience today. And then I'd like to talk about self-directing for a second, because there's a lot of people here wanting to understand how to unlock the retirement accounts. But then I want to dive really right into what you do and what we do at Horizon Trust and what the differences are, because we have so many clients that work with you and your type of clients and people. So do I, by the way. I'm a client of yours, but also a lot of people that work with self-directing. So anyway, so that being said, Carson's my oldest. He's 22, and I'm so proud of him. So Carson, why don't you share a little bit of background and of who you are besides my son?
Yeah. And I love seeing a lot of these names in the chat because I know a lot of you, surprisingly. You all come from, I think, the same place that we all are. We're all in the same circles talking about money. And so I'm happy to see some familiar faces and names. But we, I'm actually newly married, married to my wife, Anna. We live in Southern California, and we've pretty much been here since I've been here for a long time. I left and went to school for a little bit. I ended up going on a mission for a little bit as well. And then I came home afterwards and I was kind of learning what I wanted to get into, having all these different outside sources. I was going to school, talking to my peers and friends and learning about money from my dad and from other mentors of mine. And as I've, been going through this journey, I realized a point about last year, do I want to continue to work, go to school, and learn how to be an employee and kind of be a part of the rat race? Or I had the option where I was also learning about real estate investing, entrepreneurship, financial freedom and control. And I had these two conflicting ideas coming back and forth every day of which route do I want to go down. And it was to that, that tension pulling these two things apart that brought me to a point of decision, which was to kind of leave that game, quit school, and start learning about the wealth game, start investing in real estate, start protecting money and teaching people how to work with how to make money work for them. And I'm so fortunate that I've had these people around me, these opportunities to learn this stuff at such a young age, because I talk to people every single day who don't understand how money works and are trying to rework their brain, and they're just so ingrained in them what they've thought money should be doing and how money can work. And there's so many other ways to use and treat money that we're not taught. And I knew of this stuff at such a young age, and I feel like this is my calling almost, is to teach this to everyone else who's in their younger years trying to understand money, and hopefully directing them in the right path while they're still why they have or why they want to, just like I have. And so I went down the space of learning about infinite banking and self-directing retirement accounts. And today that's really what we want to talk about, is how to unlock all kinds of money, because there's different kinds of money. You have qualified money and you have non-qualified money. And so there's different ways to control each of these types of funds. And so we want to talk about both of those today.
Perfect. Well, look, I could just sit and listen to you talk just because I'm so proud of you. But I also still know you have a lot of lessons to learn, as we all do, including myself. So let me just kind of jump into that a little bit. My focus has been really for 15 years is teaching people how to get access to their retirement funds. And
Yeah.
one of the great things about having younger guests like Carson is I think it's encouraging for maybe other people's children or you as well. Like, hey, look, if a 22-year-old can do it, who is new to the industry and of money, then I can do it as well. And I actually truly believe that's the case. As smart and as hardworking as Carson is, he's just taken all of the content and education and what he's learned from many individuals and is applying a couple principles to create success. And I'm starting first with self-directing because that's what I focus on. But I will tell you, Carson, before he was doing infinite banking, he created a Roth self-directed IRA. He's also been doing one of the few things that most kids don't do when they're 18, 19 years old, which is creating a retirement account, something that he can use and unlock and put the money into things that he understands. And so just a few minutes here I want to take on this, and then I want to kind of turn the time over to Carson to talk about infinite banking. And then at the end, we're going to talk about how they can work together, not apart, but how they work together. So first, for those of you that are new, and I know there is about half of you that are new, self-directing is not a new thing. This has been around for over 40 years. And so many individuals don't know they have the option to use or put their retirement funds, and wherever they might be right now, move them over to an account like a Horizon Trust Company and self-direct it. So what does that mean? If you have a retirement account that's a simple SEP, Roth, traditional, or old 401k, you have the option of moving a part of or all of those funds into a self-directed account, which is what we do at Horizon Trust Company. And after it sits at Horizon Trust Company, you now can self-direct that retirement account, meaning you can self-direct and pick alternative asset classes. Typically, people that come and work with us at Horizon Trust are looking to invest in real estate or in Bitcoin or in businesses and precious metals. And Carson can share some of the things he's done as well. But the list is almost limitless. And so people that are kind of sick of the stock market, and there's a lot of reasons we may be sick of it in the last few weeks, at least talk about it. You're probably listening, you're in this group today, and you're probably one of those individuals who take action, who show up and want to learn more about what they can do with their IRAs. Yeah, you are the right kind of people that we want to be talking to and educating and teaching and telling you, really, when I call myself an expert in the self-directed space, I've seen over 10,000 IRA holders open up accounts with us and invest in different asset classes. The reason why I'm an expert in my space is I've seen it. I get to see what people are investing in. I get to see when they lose, when they win, where the big successes are. I get to see how to avoid the taxes, how to defer the taxes. And that's one of the big things at Horizon Trust with self-directing is our role is to help you learn how to defer or avoid paying taxes on the funds that you make when you invest. Not evade, right? Avoid or defer. And so a lot of individuals like to be investing in different real estate transactions or businesses, and they do it with outside money or non-qualified money, like Carson said. So when you invest with non-qualified money, when those profits turn and come back to you, you pay taxes. So the idea is if you can just invest using some of that money and invest it in a retirement account, or use an old retirement account that you have and self-direct it with us, and then invest it in asset classes that are passive, where you can avoid or defer paying taxes, it's a game changer. And why is it a game changer? Well, the reason why is because you and I, if we both invest in the same thing, but one of us is doing it in an IRA account and one of us is not, over a decade or 2 decades, even if we make the exact same rate of returns, you pay taxes every year or every couple of years on your gains, I will have hundreds of thousands, if not millions more in my account because I am compounding my profits inside my retirement account year after year. It's a very powerful tool. It's not a new thing. At Horizon Trust Company, we literally help hundreds of people every single month establish their retirement accounts. We're going to come back to this subject in a little more detail. And in a couple of weeks, by the way, if we're going to have another Zoom, and I'm going to talk about specific examples of what people are investing in the last 60 days. I'm going to share with you examples of what people are doing right now and where they're having success in the self-directed IRA. But first and foremost, I want to create a fundamental kind of platform where the self-directed IRA is and who qualifies for it. And for those of you that are listening that have a self-directed IRA, the next step is then picking and choosing what kind of investment that you want to be investing in. We don't make that decision for you. We don't get paid to make any decisions you make on the investments you do. Our job is to report to the IRS contributions and distributions, and to give you the flexibility to invest in what you want, but not make any mistakes. So that being said, a couple of things as I turn this over a little bit to Carson, I wanted to say, you want to stick with us because at the end we are giving out two different incentives, I guess, for sticking around with us, and they're cash incentives. We're going to be giving out American Express cash cards. So usually we give out some other kind of things, but this is real cash. So we're going to, draw names kind of from the hat kind of thing. So you don't want to miss that. As well, I always forget to do this. Carson and I also have we started a podcast called Generational Gains. Started that this year, and we've been doing just on different subjects what he and I are learning and what maybe he's experiencing today as he started his real estate career and also his business, and what I'm doing today. It's a really fun father-son thing. And so if you don't listen, follow us on YouTube, on Instagram. We're putting out all kinds of education and content. It's really about giving. And that's one great thing that I feel like Carson understood way before I did. I feel like one of the things that I failed to understand when I was 23, 24, starting a family is like, how do I pay my bills? So what can I do? What do I need to sell? How much do I need to sell so I can pay my bills? Rather than, and it took me a few years, about 5 years, to figure out that what can I do to help and serve and give to others first?
Yeah.
And once you do that, obviously people will come and they'll ask questions and want to work with you. And so I know Carson's figured this out. And so without further ado, Carson, and hopefully, and we'll go back to self-directing. I definitely, for those of you that want to understand and dive deeper into how to get access to your retirement accounts and invest in different asset classes, I'm going to go back to that as well, because many, many of our clients do what Carson does and also do what I'm doing. In fact, many of you are listening today and want to know what's the difference and how do they work together or apart. And before we do that, Carson, I think maybe that's a good time to kind of give a little bit more background on what you do in kind of a good fundamental place on infinite banking.
Yeah, and I actually want to start with a little bit more with the chat too. Those of you here, there's a lot of you here today. How many of you guys have a self-directed retirement account? And then how many of you do not have a self-directed retirement account? Not. Okay.
Yes, I do. Not
a lot of you guys do, a couple not.
Perfect.
A good mix. Okay, good. So yeah, all right. Well, so what he's talking about is finding ways to control your retirement accounts. If this is your first time hearing that, continue watching my dad's channel, looking more into Horizon Trust, and learn how that can work for you. But every one of you have money, whether in the qualified space or the non-qualified space. How many of you guys, and again, throw it in the chat here, do you guys have an infinite banking policy? I've seen a lot of you guys in here that I already know, so I assume a lot of you do. But who has even heard of the term infinite banking? If you have no idea what it is, we'll get into it. Okay, so there's, again, a good mix. So qualified and non-qualified money, that's the conversation today. So when we're talking about what's the most efficient place to store your qualified money? Most of the time it's a self-directed account, and most of the time it's even a Roth account, so you can invest and grow tax-free. Now, with there's non-qualified money, all your money that basically you're saving and your checking accounts, you use to buy cars with, you finance things with, you invest in, you buy gold and silver with, you do real estate flips with, like any of these investments not in your retirement account is considered non-qualified money. And that's the money that we want to find the best way to control. And so that's what I want to dive into a little bit today with infinite banking, and just give you a little quick recap of what it is. We're going to have a lot of questions at the end of this. So if you do get questions for what I'm about to talk about, throw them in the chat or the Q&A in the Zoom, and we'll get to them at the end. I don't want to miss any of those. But I'm sharing my screen. Tell me if you can see this. You're good?
Looks good. Looks great.
Okay. So when it comes to non-qualified money, I ask this question. I want you guys to seriously think about this. Could it be possible that there's more efficient environments to store wealth outside of commercial banks that we are not aware of? Now, think about that. Where are most of your monies right now? Probably sitting in a checking account, high yield savings account, something like that, right? Well, are there more efficient environments to store money? What do you guys think? In the chat, I see a couple of you saying yes. If there were, what do you guys think those would be? Yeah, no, I love it. Yeah. So, yeah, I mean, definitely. Now we're talking about, and what we're talking about with environments to store money. I'm sure most of you have read Rich Dad Poor Dad or Tony Robbins' book, Money Master the Game, right? These money books. What are we taught in these books to do? We're taught a lot of different things, but one of them is to save 10% of our income. So I hope most of you guys that do that at the bare minimum, hopefully more. But in today's environment, in today's economy, the average American only saves about 5% of their income. It's just simply not enough. It's not. And so, where are most people storing these funds, and why aren't people saving more? Well, in America, I don't feel like we value savings. We don't value the retention of our dollars or the control of our dollars. And I think one of the reasons we don't is because we don't have very sufficient or efficient environments to put that money, to store it. Places like savings accounts or high yield savings accounts, sometimes even current employer 401ks, sometimes are inefficient. You don't have control. It's hard to save money in those places because they don't really do anything once they're there. And so when we're talking about that, well, what is that more efficient place for us to store our money? And that's what we'll dive into right now. So there are other ways you can store your funds. And I'm going to call the place you store your money your bank, right? This is going to be your bank you store your money. And we're going to compare it to a traditional savings account where most of us save our money. So what are the attributes of your bank? Well, in your bank, both places are liquid. In a traditional savings account, your dollars are liquid. In your bank, your dollars are liquid as well. So great. We'll treat this like a savings account. And who doesn't want to deposit more money in their savings account, right? Everyone does. So same thing with your account. Now, what if your bank, the place you stored your money, was compounding interest, 2 to 6% or more, guaranteed every single year of your entire life? That's what I mean by uninterrupted and compounding. No matter what happens in the market, these dollars are going to grow. And in a traditional savings account, the average growth right now is 0.07%. And you're taxed on that 0.07%. What if I could tell you your bank was tax-free and protected? If you were ever in a lawsuit, a judgment, a lien, the market crashes, what if it was protected and stable? No one could touch it, and it was going to constantly increase in value throughout life. Now, wouldn't that be a much more efficient place to store money? This is a place you could control, you can count on, you can use as a foundation to really finance everything throughout your life. And it's hard because obviously there's chaos in the world, life always gets in the way, but if you're able to save money, why wouldn't you do it in your own bank? If you had an opportunity to put money somewhere that was still liquid, but it also was compounding, it was guaranteed, tax-free, risk-free. And I'll add one more thing to this. What if I was to tell you that in your bank, if you were ever to take money out of it, it would actually not stop the compounding? Now, we all need to dive deeper into whatever this is, right? This is amazing. If you could store money here, you would store as much as possible. Well, so to make this strategy work, we need a machine, and this machine is the bank you're going to use. And all we're doing with this machine is we're running our money through it. That is it. All you're going to change is one thing, which is where your savings, the money you keep or have excess every month, goes. It's going to go into this machine. And before I even tell you what this machine is, I want to read you this quote from Will Rogers, where he says, "The problem in America isn't so much what people don't know. It's what people think they know that just ain't so." So don't judge this quite yet because you don't understand it yet. But I'm going to show you what it is and how it works. The machine we use to do this is nothing other than a dividend-paying whole life insurance policy from a mutual company. Now, a lot of you guys might think, oh, why is he trying to sell us life insurance, right? Well, this is not insurance you get at your local insurance store down the street or your brother-in-law who sells insurance. Like, that's not what this is. This is a specially designed policy. It is whole life, but it is specially designed. And a lot of people have questions about this because they're told by Dave Ramsey and Susie Ormans that that's a terrible place to store money. They say buy term and invest the difference, right? I mean, I'll agree with them. If you put your money in a regular old whole life with the expectations of it doing what I'm about to show you, you're going to be really upset. So again, this is a specially designed policy, just like the Ford Focus down the street. If you were to go to a Ford dealership and look at a Ford Focus like this, I mean, it's a decent car, right? But it's not anything crazy. But what if you're at home, you're browsing YouTube, and you look up a guy named Ken Block, and he's in a Ford Focus, this Ford Focus, oh, going 150 miles per hour around a turn. What's different between this Ford Focus and the prior one? It's just the design and engineering of the car. So same thing with this policy. It's still a Ford Focus. It's still a whole life policy. It's just structured differently to be more efficient for what we're trying to accomplish. And so to add to this, a lot of people around whole life say, it's low rate of return, it's expensive, or it's the worst investment. If you're watching this, I want you guys to take a note of this. I encourage you to write this down. Whole life insurance is not an investment. It has nothing to do with investing or investments. This is a control and a banking conversation I want to have with you. It's about controlling your non-qualified money. And instead of storing your non-qualified money in a savings account, you just store it in this policy. So if you're to take anything from this little section today, is that whole life is not an investment. And when you start talking to your neighbor, your business partner, and they start telling you, don't buy whole life insurance, it's a terrible investment, it's got a low rate of return. Well, as soon as you hear someone call whole life an investment, you now know that person has no idea what they're talking about, because they can't even correctly identify what type of asset it is. You cannot get a policy built for banking from a regular insurance agent or a financial advisor. You can only get policies like this from banking professionals, which is what I am. And so all we're trying to do with this is have more control over our dollars and be like the wealthy do, and do what the wealthy do, is storing their money in these assets, in self-directed retirement accounts, investing what they want, and whole life insurance with their non-qualified money. And so to end, just to give a little bit of credibility behind what we're talking about, look this up. BOLI, bank-owned life insurance. You all know these banks, Bank of America, Wells, Chase, Citi. Look how much money these banks own in these specially designed policies. And what you'll find if you look BOLI up is you'll find that banks own more whole life insurance, not IULs, not term insurance, whole life, than they own in land and buildings combined. Banks are the number one purchaser of whole life insurance in the world. And not only do they own more whole life, but they keep buying and buying more every single year. So $60 billion in whole life insurance, they must know something that the average American doesn't, right? If they're doing it, why aren't we? And I could give you a whole list of wealthy families and politicians who'd use these policies as well. But the whole point of this conversation today, now that you have a little idea of what whole life insurance really is, how you can use it to finance things you need throughout your life, that's what my dad and I want to talk with you guys today about, is just how you can now use whole life insurance and self-directed IRAs and actually be running money through these two things. And maybe we'll even show you some examples as well.
Yeah, so I want to add to this because I've heard Carson actually a couple times talk about this, and normally he speaks for 30 or 40 minutes, and he's able, and in fact, you'll do this for anyone that wants to schedule an appointment, and again, it's or even just follow him on social media, etc. But he'll explain to you what this means and how you create your own bank, and I want to take it kind of from my perspective, because I had been doing this for many years before Carson was doing it, helping people set up their policies. Now I've set up more policies, mostly because Carson's like, hey, why do you have so much money at your bank account, in your savings accounts? Why don't you put the money from your savings account into an insurance policy? And the focus is not a death benefit, by the way. The focus is the benefits he just said of your bank, compounding and non-taxable and protection. You put the money there, and then you borrow the money out as you need it for different purchases and loans, et cetera, rather than from a bank. You borrow it from your own bank. And so that's the powerful part of it. And what also I think what's great about these policies is it works for anyone pretty much at any age. So most people, when they go to get life insurance, and by the way, I'm not licensed to sell life insurance, so I'm just giving my perspective as I was listening to Carson. Most people, when they start talking about the subject, they're all worried about what is the death benefit. That is not what this is about. You want to put in as much money as you can into these accounts for the savings part of it, so you can take that out as a loan and use it for whatever you want and get the least amount of death benefit. This is really a life insurance policy. It's meant to be used while you're alive. The example I'll give, and the example that Carson can give any one of you, maybe not today, but if we have time, we can do it as well, is there's a perfect example of you, an individual, if you're going to go buy a car for $50 or $100 or $150,000. Let's say you were going to buy it for cash. Well, instead, you take your money from your savings account, put it in an insurance policy, borrow the money, and then start making payments as though you're going to be paying that a monthly payment to a bank if you were going to borrow the money back to your own policy. And over a 5-year period, not only will your car be free and clear, but you'll have the exact amount, if not more money, that you originally started with. So you end up after 5 years having the car paid for free and clear, and you have that original money you started with in your policy that you can re-loan out to each other or to yourself or on a different investment. That's a little bit. And by the way, and still, I feel like, Carson, I'm cutting you a little bit short on this because you can go on and on and on for those individuals that want to understand how this works a little bit better. But this is really meant for individuals that have non-qualified, which I saw as one of the questions. Non-qualified is monies that are not retirement funds, which is mean it's a retirement fund is qualified. So if your funds are in a IRA, 401k, Roth, traditional SEP, all those are qualified funds, retirement funds. If it's non-qualified, is outside of retirement account. And so there is this distinct difference, and they still can work together. And so when Carson teaches individuals how to use this and create their own bank, I know, because he and I've spoken about it, he'll do a one-on-one call and be like, okay, let me find out more about you, what your goals are, how much money you can put into a bank account or into your bank account. And then you kind of create your own illustration. You put together your own plan with him and figure out what works for you in particular. So if it's $500 a month, or if it's $10,000 a year, whatever the case is, you establish that with him. And he's done that with me as well. I've established these different bank accounts as well for myself, for my wife, for the kids. And it is a very powerful thing. And all I've done is create a machine, and I'm just reiterating what Carson just said. It's a machine on how you use your money. That's it. So instead of it first going to a bank, you're putting the money into an insurance policy, a whole life policy, and then you're funneling it back out. And so and when you funnel back out, then you pay yourself back. And so you become the bank, you control your money. And I think the powerful part of this, and why I wanted Carson on here today with me, is I can't tell you, I feel like almost every month I do a webinar, and the title of the webinar is, I say, unlocking your money to invest in what you want and understand and what you know. And it's unlocking your money, which coincides with your message about unlocking your money from a bank account and putting it in something that you can control and that's more stable. And so that's how these messages actually do work together, even though they're completely different things. And so for those individuals listening today that have a retirement account or an old 401k from a previous employer, and you never understood or wanted to understand if you could move that money into real estate or in precious metals and gold or Bitcoin or in different businesses, you can do that. And if you go to your advisor right now and say, hey, advisor, I want you to keep $100,000, but I want to put $50,000 into my buddy's real estate deal. Excuse me, you can't do it. You can't call Charles Schwab and say, hey, move that $50,000 to title, and I'm going to lend him the money, and we're going to flip this deal, whatever the case is, and then I want the profits to come back into my retirement account. They don't allow you to do that. And it's because they're a fiduciary. Their role is to actually show you your options that are traditional stock market kind of options, which are not bad, by the way, for everybody. They're just not right in particular for people that take action on their money, that want to control their money. I don't want to be investing my retirement money and my future in somebody who potentially could wake up in the morning and say the wrong thing, right? Elon Musk. And all of a sudden the stock goes down and that's my retirement. Or Apple, or the wrong thing is said. I like to invest in things that I know and understand. And that's why
And control.
self-directing and
Yeah.
control, and that's why self-directing has gotten so powerful for me.
Yeah.
And why the unlocking your money has it, how it coincides with Carson and I know Chris and those that work with you, your message of unlocking the money from a bank, traditional bank that doesn't have all the same benefits, and then investing it in self-directing. So let me just talk about that for a second, Carson. And I'm just curious how you'll answer it because I have my own answer, but I'm going to ask you. So people ask me all the time, what is, can I do both? How do I do both? Maybe a better question is, as far as self-directing, is what should I do first? And I'm just curious how you'll answer it, and you can answer how you want, but I get that question all the time. Is self-directing, or maybe answer this, is self-directing better than infinite banking, or vice versa?
Yeah.
That's a question you get as well. So go ahead and answer any one of those questions.
Yeah.
Um,
Yeah, no, I mean it really is an open-ended question because there's no one size fits all. It's so situation dependent. So I can't say one way is better than the other. You use them both. I use them both. Most people can use them both. The exact percentage of how much of your income you should be running to retirement accounts versus 401ks versus policies, that's very situation dependent and your goal dependent. If it was the perfect world and you were investing in rental properties and you were young, then I'd say, well, maybe don't contribute to a 401k with your company. Rather, run those funds through a policy and go buy rental properties. But someone might have 30 years of the company and they have a big 401k they've built up. How would I control that? Well, I don't want to pull all that out and pay a huge tax bill. I'd rather roll it into a self-directed, start investing and lending it out in real estate, and then slowly rolling it over to a Roth and slowly paying the taxes over time and continuing to compound tax free. Like, both options are great. It just totally depends on the situation, the time frame you're in. But anyone at any age can do either of these things. So, Scott, I saw your question: is infinite banking only for younger people? No, most people I work with are actually in their 50s and 60s. Funny enough, and so same with
and
my
that's not
dad.
old, by
And
the way. That's not old, by the way.
yeah, it's not, no, but it's older than me. And
Oh,
so and so, I mean, anyone can do both of these things. I'm going to continue to contribute to Roth IRAs my whole life. I'll keep investing in deals gaining tax free, and I'll keep running my funds through a policy. So it's just very dependent upon the situation.
yeah, and I'll add to that as well. I agree that answer is perfect because it does depend upon your variables. Most of our clients at Horizon Trust Company have already established. If you're listening and you aren't with us at Horizon Trust, there's a good chance that 50% of you that are listening already have some kind of old retirement account. If you have a retirement account of some sort, a traditional Roth or Simple or SEP or an old 401k or 403b, it makes sense to transfer that over into a self-directed account because you don't pay taxes when you move it over. And when you invest it in assets, you don't pay taxes either on those gains. And so that's the right kind of people. Now, that should be self-directing. Now, the question comes up more for people like Carson's age. I'll have people come up to me and say, hey, look, I'm 22 or 25 years old. I have $5,000 or $10,000. That's all I got right now. What should I do? And the answer probably most likely would be starting an infinite banking policy. But what you can do, what people don't talk about, which I think they should talk more about, is you could establish an infinite banking policy, put your $5,000 or $10,000 into that policy, borrow out $5,000 or $6,000 or $7,000, or as much as you want, really $8,000 or $9,000, out of your policy, your life insurance policy, and then you could fund your Roth account. So now you fund your Roth account, and with your Roth account, the reason why I like self-directing, I like both of them, they both work hand in hand, is with your Roth account, now you can go out and flip or lend or partner. And when your $5,000 turns into $10,000 or $25,000, let's say in one year or 2 years, all that money is, if it's in a Roth, you don't ever pay taxes on. You won't make those kind of returns inside an infinite banking policy. Because what he said, it's not an investment. That's not the point of it. The point of it is to do your banking there. So now instead, when you go to do your banking there, now when you go to borrow money to buy a car or to pay whatever it is that you need to borrow money for, right? Or even if it's to pay off some credit card bills, you borrow the money from your policy, pay off higher interest rates, pay off different expenses. You become the bank with your own money and start making monthly payments back. This is what I do on my own for my cars. I'll buy the car, I'll take out $100,000, buy the car cash. Then I put in the calculator, right? How much would be a monthly payment over 5 years on a $100,000 car? Boom, it comes out $1,400. I then set up auto pay that I pay myself back, my insurance policy back, $1,400 every single month. And so I rinse and repeat. I do it over and over again. It's very powerful when you become the owner and you control your money on both levels, both your retirement funds, but also your non-retirement funds.
Mm-hmm. There's a couple more questions in here too, if you want to hit those, more about the policy.
Yeah, let's look. It's 4:43. We're going to go longer probably than 5 because I see there's a lot of questions in here, and frankly, just to be clear, we could go a lot deeper on both subjects. I feel like Carson should and could give you some very good examples of how this would work for you. And so Alex is putting here in the chat. I think Alex has. He's probably put your email in there, Carson. For those that want to reach Carson, you can personally email him. For those that want to set up a self-directed IRA account and schedule something with my team at Horizon Trust, and when I say set it up or even just learn more how this qualifies for you, or if your retirement account qualifies to be self-directed, just schedule an appointment. There's no hard sell here at all. We want those. We get to pick and choose our clients. That's one thing that's very unique that I've been able to build over this couple of decades now, is we want to work with people that want to work with us. And so we're not out there. There's no hard sale. If you've got questions, set an appointment with me and my team. Send an email to Carson or myself and say, hey, I'd love to learn more about how this applies to me. You didn't go deep enough nearly, Carson, so can please share with me, because it is a kind of a subject that's unique. When I first hear about whole life and life insurance, I do get turned off. And so I think you nailed it right away. Like, okay, maybe I won't get turned off because he's got something different to say, but I think you need to figure out how this works for you in particular. When it comes to self-directing, again, Alex has got our appointment link there. You can schedule an appointment. We'd love to help you understand how to get access to your retirement funds and invest it how you want to invest it. It's truly badass. I enjoy it. So let's hit some questions. I also think we have Claudia here. Claudia on my team, is she listening? For those of you who are clients of ours at Horizon Trust, most likely you've either worked with Claudia or you've worked with someone on Claudia's team. I always like her popping in here because I feel like many of you already know her, but she is very detailed in helping people with the process of getting their money established and set up. I also think, Claudia, also you are you also do infinite banking, correct?
I do, yes.
You do. So
and Carson, I was one of his first clients when he explained it to me. What was it, 3 years ago, Carson? 3 years ago?
Probably, yeah.
It was a while ago. So yeah, I definitely do it, and I love the concept, and I really like how it works.
And I have to say, Scott, yes, Claudia does love the sports talk. I appreciate Scott. So he knows that.
Oh, they remember
that football is starting. So cannot wait. Anyways,
I love sports.
So anyways, yeah. Do you want to hit some of these questions that we've got here? That'd be great.
Yeah. And I'm trying to even go through some of these right now and answer, but there's a good one in the Q&A from Lucy Lyons. This is for you. So she said, my elderly mother will be selling a house soon. Would I be able to open a self-directed IRA with the proceeds? I am the trustee. The funds will be going into a regular checking savings account, and I would love to be able to direct investments for her.
So if the money is outside of a retirement account, which is what I just understood, when the house is sold and the money's going into the checking account, you can set up and establish a retirement account with those funds. And this is one where you definitely want to schedule an appointment, because there's a good chance if you want to do investing and create a real estate business and avoid or defer paying taxes on that. And Claudia can help you with this as well. What you would do, and we have a lot of people do, is you would create an LLC, and inside that LLC, you'd create a 401k, a self-directed 401k, and you could contribute up to almost $50,000 or $60,000 potentially. Again, we got to do a call with you to see, but you can end up putting money into retirement account, and you might have to do it over a few years, a period, but then you can start investing those things in different real estate transactions. But what you can't do, just to clarify, is you can't let's say you get $500,000 from the real estate sale. You can't put it all into a self-directed IRA and start investing in it. I would love to say yes to that, but you can't do that. But that's okay. Don't make that deter you from that. You can establish a retirement account, a self-directed account, fund it from the checking account that you just said, and we'll help you get that account set up and start doing real estate transactions. Great question.
That's
And
correct.
would you be able to say she sold it and got 100K profit? Would she be able to run all that into an IRA?
She would have to stay within the contribution limits. So she would definitely have to see what she's able to contribute. If it's a regular IRA, it's about $7,000. And if she has a 401k, if she's running a business, she has higher earnings and the business has earnings as well, then she can go ahead and do up to $63,000. So it just depends on what her scenario is. We can definitely go over that with her and kind of strategize with it, but she wouldn't be able to put the whole thing into it at once. So I have Frederick here that says, I transferred money from a 401k to a Roth IRA self-directed and was taxed. Where did I go wrong? I would have to look at that, Frederick. What probably happened is that you converted some of your funds. That would be the only way that it got taxed, unless it didn't go from a qualified account to another qualified account. But the only way that that would get taxed is if it went into a Roth account, which at that point you're paying taxes now so that you can grow that account tax-free for the remainder of the account life. So that would be what I would think. But let me go ahead and write down your information, and I can definitely look up your account and give you a call tomorrow.
Yeah, let's do that. Perfect.
Scott is asking, what is the difference between a QRP and a self-directed IRA?
A QRP is a qualified retirement plan. So I feel like that's a kind of a pension plan for a self-employed employee, or I'm sorry, a self-employed employee. So that's, I don't know, there's too much difference. You can set up a self-directed IRA account as a QRP. So I don't think there's any really difference that I know of as a QRP at all.
Now, a QRP is a type of retirement account, so we would transfer it over to a self-directed IRA on the Horizon side, or a self-directed 401k, which is sponsored by
just
a
like a
company
401k,
as well.
right?
Yeah,
just like a 403 or 401k.
It's just another term.
You could move that over just like a 401k. Yeah.
Correct. Perfect. Yep. Do we have any other questions? Okay, so I have David who is asking, please talk about the advantages of a checkbook LLC and how that would benefit us.
Yeah, look, so checkbook LLC is really meant for those individuals that are doing more transactions and using their retirement account. So for example, let's say that you have a self-directed account or retirement account, and it's established, it's moved over to Horizon Trust Company, and you plan on buying an asset that has multiple transactions. Meaning, let's say you're doing a buy and hold property. You're buying it, fixing it up, and then you're going to hold on to it. But you need to hire a manager. You're going to pay taxes, utilities, management fees. When there's multiple things happening in an asset that you invest in, a checkbook LLC is nice because instead of requesting those monies to be sent from Horizon Trust out to these different vendors, what you do is you have Horizon Trust send X amount of dollars, let's say $100,000, to a LLC that is owned by your retirement account, but you are the manager of it. So from there, you can direct funds, you can write checks, you can send wires to pay the bills to manage the asset. There's just some rules, and we walk you through that you can't do. For example, you can't pay yourself a commission or a salary, things like that. You can't commingle non-IRA with IRA money. But I will say that this is something that many, many people do. So if you're interested in learning more about the checkbook LLC, definitely schedule an appointment. With us for sure.
Yes, and we do help our clients set those up, and we have a promotion actually, $500 off the checkbook LLCs. They have specialized operating agreements, and it's definitely something that is not as easy to set up, but we help you through the process and set it up for you. Well, we work with a company that sets it up for you, so definitely call your IRA specialist if you're interested in more information, Roger. Okay, I have Robert. If I buy real estate with my SDIRA and rehab it with my own money, what needs to go back into the SDIRA and what can I keep? It's a good question. Go ahead, Greg.
Well, it's a little bit complicated. It really, the quick answer is you should not commingle IRA with non-IRA money. Now, is it possible? Yes. The important part of that is making sure that, like, the accurate way of doing that, if you were to do that, sounds like you might have already done that, which would require, I think, a follow-up call, Claudia, that if you are a client of ours, we should talk to you about that to make sure you don't mess it up so you lose your taxes, have no tax liability, I should say. So basically, let's say that your IRA does $75,000 and then you've put up $25,000, and this asset is owned by this maybe an LLC, but it's owned 75-25. Well, that the pro rata profits and upside need to be split appropriately. So you can't have more go to your IRA or more go to you individually. It needs to be pro rata. You can't lend you can't lend using your personal money to your IRA. You can't do that. And so it gets a bit tricky and could be prohibited if you're not very careful when you start commingling IRA with non-IRA. What I always recommend is don't commingle if you can help it. And what you should do is have your IRA be an investor / partner, and then somebody, not your kids or your parents or yourself, be a partner or lender to your IRA to do the rehab on that project. That's the ideal way, is get a loan from a bank or from another individual or from another IRA to really keep it divided. So that's a tougher question because I need to know a little bit more the percentages and dollar amounts. But yeah.
He said the money's still in limbo, so I think we're still good, and now he has the answer. Robert, if you have any more questions about it, or you want to schedule an appointment, just schedule an appointment. We'll be able to go
let's
over
do the call. Let's do the
your
call.
specific scenario.
As soon as you can. Yeah.
Yeah. Okay, I have Scott that's asking, I heard that a person can't lend money from an SDIRA for anything that benefits them directly. Is that true? Kind of the same scenario.
Yeah, kind of the same thing. So I can't lend it to Carson or myself, and then I get a commission that's paid to me outside the IRA or a salary, etc. There's a fine line on prohibitive. That's why it's ideal and it's meant for when you're using your self-directed IRA, you should try to be investing in something more passive, a syndication, a partnership, a loan, etc. Mm-hmm. But the list goes on and on. There's so many things. I mean, Carson, I've shared your example a few times. You've flipped forklift with your IRA, correct? Am I wrong?
Mm-hmm. Yeah.
So, yeah. That's it. Yeah. Yes. So what you did, though, correct me if I'm wrong, is there's somebody who's looking for money so they could buy the forklift, fix it, and flip it. You put up the money, and you got a percentage of the profits, right?
Yep. Yeah. That's it. All I needed was easy enough.
That's what I was looking for.
Okay. So Carlos is asking, can you lend from an SDIRA to an LLC you own outside of the SDIRA?
You would not be able to do so.
Yeah. You wouldn't be able to do so. Yeah. That would be commingling funds. The IRS is not like that. So it's something that we don't typically recommend. Kevin is asking, a Roth IRA can purchase an annuity which is not life insurance, even though it's sold by insurance companies. I was also told that an IRA/Roth IRA cannot purchase or own life insurance policies such as IUL. Which is life insurance? What is the whole life? What is that whole life is allowed? So what can they buy?
Yeah. That's true. You cannot buy life insurance policies like infinite banking with qualified money. That is accurate. Mm-hmm. But what is confusing is annuities are from life insurance companies, and you can invest your qualified monies in annuities.
Yeah.
So these are great questions. I don't think I've ever feel like I've gotten peppered some of these questions. This is a good one. So it is a little confusing, but it is not a life insurance contract on your life. And so you can invest in an annuity. So yeah. And one other thing, since you're all listening, pins and needles, I want to do our plug one more time. You obviously follow us on Generational Gains. But if you want to schedule an appointment, Alex has put his email in there. Please email Carson. He will definitely give you he will give you his time and energy and support. He helps literally between 40 and 50 new people every single month set these policies up. And he's done this for over a year now. I mean, he's done, I don't know how many you've done, maybe 1,000 at this point. You've done a lot of policies. So he can help you. He said he helps my friends get policies set up. So absolutely send him an email if you want to know how this works for you. Or if you want to know if the self-directed works for you, schedule an appointment. There you go. That's my plug. Well, hey, I will say, look, I'll be back here in 2 weeks. I'm going to dive deep into self-directing and exact examples of what's happening. If you want to learn more, obviously follow both of us. Thanks for being on here with us. I don't know if if you want to keep going on questions. I feel like we want to be respectful of everyone's time here. It's 5 o'clock. So thanks for listening. Email Carson, follow us. In 2 weeks, 2 weeks from today, we'll have another webinar, and I'm going to go over a lot more details and specific examples of what people are doing with their self-directed IRA. So thank you very much, everybody, and have a great night. Thanks, Carson. Thanks for coming on with me, buddy. Appreciate you.
See you guys. Yeah, thank you.
Hey, thanks for watching this video. Hopefully you enjoyed it. There's lots more great content for you to learn and enjoy and apply to. And so anyways, click on the link below and listen to more videos or set an appointment with us. We look forward to hearing from you and also helping you.